I've said before that we think that between 1.5% to 2% is a reasonable real rate given where we are in the business cycle. Now, of course, different people have different views. You had a panel discussion with Dr. Rangarajan where he would like to see it closer to 3. There are some people who would like to see it closer to 1. There are others who mix and match and add in various risk premia and claim that the policy rate is now way into real territory. So we have to be a little careful. What we would like is the real risk-free policy rate to be about 1.5% to 2%. We can only comment on the fact that despite a fall in long-term interest rates, a substantial fall, treasury rates have come down a significant amount over the last year and a half. And corporate bond rates have also come down substantially, that bank lending rates have remained more or less flat over this period. Now, you see some movement on new loans made by banks. There's been some adjustment in rates, but in general, base rates haven't changed. Of course, when you talk to banks, they're very happy that we cut rates. At some point, my guess is transmission has to take place.
All right, Saloni's been at the RBI. Before I get to Saloni, there's a flash at the bottom of your screen. Britannia Industries reporting numbers of the profit as well, coming in 137 crores is in line with estimates. Our estimate that we're working with at Bloomberg is 135 crores. On the revenue side of it as well, we were expecting profits. We were expecting revenues about 1,800 odd crores. That's come slightly ahead of estimates, about 2,200 crores. Margins are supposed to be steady, and business from the biscuit segment, which is the majority of Britannia's business, is likely to be firm. Varun Berry speaks to the media today at 5 p.m. so watch out for that one. Saloni Shukla, let's get back to the top story of the day at the RBI, giving us a roundup of what really transpired at the central bank.
The biggest takeaway was the fact that for any further policy action, governor will wait for more data, and he clearly said that budget will be the big event to watch out for when it comes to commentary around fiscal consolidation. Both the quantity and the quality of the fisc will be very important to watch out for, which he clearly reiterated time and again during that press conference. As far as inflation is concerned, he said that he's seeing that 6% mark averaging CPI inflation throughout the year, but Deputy Governor Urjit Patel mentioned that what they were watching out for is the rebasing of CPI, and that will be very important for RBI when it comes to really looking where the inflation trajectory is panning out from here onwards. As far as current account deficit is concerned for this financial year, their target is about 1.3%. They said that for the next financial year, they will revise that particular target downwards as well. But two important things as far as banks are concerned, one on rate transmission and the other on regulatory forbearance. Remember, not even in this policy, time and again the governor has mentioned that he is not happy with the kind of rate transmission that he is seeing in the system. He reiterated that yet again. What he said was that the banks were very quick in cutting deposit rates, but very slow when it came to really tinkering with the lending rates or base rates, and that is clearly the worry. He said that he will not go ahead and nudge banks because he was a regulator, but clearly he said that it's about time that lending rates softened. As far as regulatory forbearance is concerned, and we've spoken on our channel about this time and again, that of course April 1 is the deadline for the restructuring window to go away entirely. The governor said, and this was the demand for banks, so clearly this is bad news for them, that he said that there will be no regulatory forbearance from here onwards. So April 1, 2015 is the deadline that banks have to watch out for closing of that restructuring window. Very important commentary coming in, but the key word of course is the fact that budget will be the trigger for further policy action.
Let's talk about restructuring, Saloni. There's been some easing coming in on that front, making the lenders get a little more teeth into the system. What's the policy saying on that?
Well, there was the last couple of months, we have seen that RBI has somewhat worked towards aligning the structuring norms with the date of commencement of commercial operations of several of these large infrastructure projects which are either struggling or have become chronic NPAs. The last one that we saw was just a couple of days back, where the RBI aligned DCCO norms for projects that were highly over leveraged and where projects had become chronic NPAs. Now what RBI has done today, remember we were watching out for this, it has said that as far as debt to equity conversion is concerned, banks right now are allowed to hold about 30% of paid up capital or in any project. So that formula is now worked upon, where banks don't lose out when a particular project's debt to equity is being converted. So that formula is worked out with SEBI right now, where RBI is trying to make sure that banks don't lose out or convert a lot of debt into equity, and on the other hand SEBI is trying to protect interest of minority shareholders. So we'll be watching out for that when the formula really is brought out, because it has to be in line with the capital markets, market regulators' regulations on conversion of debt to equity. Back to you.
Well, the RBI also introduced measures to increase and enhance long-term inflows into the market. The FPI regime for corporate bonds has been reworked to be alignment with the GSEC market. FPIs will no longer be allowed to invest in the short end of the market on the corporate debt as well. Remember, 68% of the corporate debt has already utilization. The limit has been utilized, and now that will, from here on, will be restricted to 3 years. On the other side, they will also be allowed to reinvest into the government securities, even though the limit has not been enhanced. But they have been restricted into investing into short-term money market and liquid funds. The essential point behind this from the RBI's end is to ensure that even though fund flows, and we might see a big gush of it, given the fact that the first half of the year, first 20 days of the year, we've already seen about $3.7 billion come in, is to secure the balance sheet and not see any severe outflow of hot money coming in. Let's hear what Dr. Rajan had to say on that today.
We would not like to be seen as against foreign investors, and given that we want to expand limits on a regular basis, given the interest in India today, if we just expand the FPI limit in government securities by some, let's say, $5 or $10 billion, it will be taken up in a couple of weeks, and we'll still get people wanting us to open more. We thought a more streamlined way of doing it would be to allow reinvestment of interest, which is a more regular feature and which will allow some room for our patient investors who have